there is a structural deficit in terms of new mine supply or newly created supply relative to industrial demand, but there are enormous above-ground inventories. The experience of Sprott, going back to, 2014, 2015, the silver squeeze, is instructive. The narrative around silver was in full swing, and the easiest way for American investors to express their sentiment was the Sprott Physical Silver Trust. We as Sprott were able to use an at-the-market financing mechanism to convert this market activity into cash, which we used to buy silver. And for a while, we were raising $40 or $50 million a day. And our charter prohibited us from taking depository receipts. We had to take silver. So we couldn't hang around and try and buy that silver at the best price from the best taker. We cleaned out the silver that was available to us in Toronto. We cleaned out the silver that was available to us in Ottawa. We then cleaned out Chicago. We then cleaned out New York.
Back to the question of silver and gold, there's a lot of discussion around physical availability of silver. You and I have discussed that in the past when during the silver squeeze, the Sprott Physical Silver Trust had to do some rather extraordinary searching at greater and greater distances to be able to find enough physical silver to keep up with the demand for investable physical silver. There's a comment here from Han SP, who says, according to the CPM group today, and I looked up this article and read it, there is no silver deficit, only marketing hype. Ray Dalio, however, claims the silver squeeze tightens. What is your opinion, sir?
They're both right. What Jeff Christian will suggest is that there is no deficit because there's inventory. And strictly speaking, that's true. There is a deficit if you look at the amount of silver that's consumed every year relative to the amount of silver that is produced from silver mines or as a byproduct of other metals or is recycled. And frequently the silver bulls suggest that this deficit is so overwhelming that the silver price has to move. What those bulls neglect to point out is there's several billion ounces of above-ground silver in inventory that doesn't have to be mined. Silver, unlike gold, is used. It's important to note that. It's used in, for reflective capabilities, as an example, in solar industry. It's used in microelectronics, in regular electronics. It's also increasingly used as a germicide and in water treatment facilities. And a bunch of silver every year, goes out a tailpipe or goes up a smokestack or something like that. It goes to silver heaven.
Yeah, not to mention the silver that's in munitions and that gets vaporized when they get used, yeah.
Sure. More silver every year right now is getting used than is getting produced. But there are enormous stockpiles of above-ground silver, and nobody really knows how much. I remember back to the 80s when Buffett suddenly announced that he owned 15% of the reported above-ground stocks of silver. The silver price promptly doubled. All the short squeeze guys, even in the 80s, came out from under their bridges or wherever they were. And all of a sudden, the silver price collapsed. And all the silver bulls were saying, well, this must be manipulation. This must be J.P. Morgan Chase trying to screw me. What it was that there was a whole bunch of physical silver owned by the Indian peasantry. The silver price doubled in U.S. dollar terms, and the U.S. dollar doubled against the Indian rupiah. At the same time, I forget if there was a flood or a drought, one or the other, but there was a bad harvest in India, and the Indian peasantries had to make a choice between selling an asset class that was up by 400% or allowing their kids to starve. Pretty easy decision. So in the context of the question that you asked, both parts are right. There is a structural deficit in terms of new mine supply or newly created supply relative to industrial demand, but there are enormous above-ground inventories. The experience of Sprott, going back to, 2014, 2015, the silver squeeze, is instructive. The narrative around silver was in full swing, and the easiest way for American investors to express their sentiment was the Sprott Physical Silver Trust. we as Sprott were able to use an at-the-market financing mechanism to convert this market activity into cash, which we used to buy silver. And for a while, we were raising $40 or $50 million a day. And our charter prohibited us from taking depository receipts. We had to take silver. So we couldn't hang around and try and buy that silver at the best price from the best taker. We cleaned out the silver that was available to us in Toronto. We cleaned out the silver that was available to us in Ottawa. We then cleaned out Chicago. We then cleaned out New York. Sidebar, gold is expensive and easy to transport. Silver is not expensive and it's tough to transport. And the people who owed us the silver, the JP Morgan Chases of the world, had to charter these very large airplanes to fly physical silver to us from Switzerland and London. Now, it wasn't that the silver was unavailable on a global basis. It's that the silver was unavailable where it was needed. And that goes to the futures markets. It's very common, Donegan, we've talked about this on your show before, because the futures markets are so liquid, because they trade such amazing volumes, it is not uncommon to see a single 24-hour period trade 200 times the physical silver that's available for good delivery. Now, invariably, these things cash settle. But if you thought about a very small amount of the futures transactions that was held for good delivery, that would absolutely overwhelm the futures market. Participants in the futures markets, or those who look at the futures markets to engineer a short squeeze, need to understand that the futures markets are owned by the futures markets participants. And if we had this type of short squeeze, it wouldn't physically settle. What would happen is that the exchanges would do what they did with tin. They would halt transactions, they would arbitrarily establish a price, and they would cash settle. That's what'll happen. If you actually think that you're going to catch the owners of the exchange way short, I got a bridge to sell you. But a circumstance that caused that to be a threat, which is to say, if there were cracks in the futures market, you could expect some really interesting fireworks in silver. I happen to believe you're going to see interesting fireworks in silver anyway. I don't think you need a really dramatic narrative to cause you as a speculator to buy silver. But I like to deal with that dramatic narrative because the facts suggest a different outcome.
We also saw that a few years ago in the nickel market, where the COMEX had to halt trading, cancel a bunch of trades, and dust off and start over. And it wasn't all those people who thought they made a truly impactful squeeze didn't necessarily reap the fruits from that they were hoping. Richard D59E says, how likely is the government to make it virtually impossible to sell gold or silver because of a windfall profit tax, in your opinion?
Highly unlikely. I remember that as pernicious as government is, they tend to do the easy things. If they lower the interest rate, which increases inflation, inflation is a tax. And it's popular. If they increase taxes on the rich, the people who aren't rich think this is a very good thing. The government doesn't need particularly to do politically unpopular things to steal from you. The government can do popular things to steal from you. The idea that the government is going to steal your IRA, as an example, I think is highly, highly, highly unlikely. The idea that in an economy that they describe as the best economy in humankind requires an interest rate decrease is a different way of stealing. Of course, their most effective way to steal, Donegan, is to index benefits to the CPI, which understates inflation, while allowing the continued deterioration of the US dollar, while simultaneously not indexing income taxes and capital gains taxes to inflation. this taxation benefit relative to benefits that has to do with the discrepancy between the CP lie and the real rate of inflation is one of the most effective and pernicious forms of theft. Well, it's the most effective and pernicious form of theft, save an armed invasion of an adjoining country, that I've ever seen. And it's popular.